Welcome to Hibiscus Petroleum's Financial Results webcast. This webcast presents an overview of the results reported as part of our quarterly financial report for the 3-month period ended 30th June 2019 and released earlier today. This webcast has been prepared by Hibiscus Petroleum Berhad, or the company, solely for general information purposes only, and shall at all times be heard and or viewed together with the full quarterly report for the same period that has been made available or published by the company on its website. This webcast may contain forward-looking statements which are based on current expectations, beliefs, and projections about future events or matters. By listening to and or viewing the webcast, you agree to the limitations and notifications set out in the disclaimer section of this webcast. Our presentation today is comprised of 6 components. In part 1, Uday Jairam, our Vice President, Corporate Development, will briefly introduce the company. In part 2, Deepak Thakur, our UK JV Asset Manager and Group Petroleum Economist, will provide an overview of and an update on developments at our UK producing asset, the Anasuria Cluster. Mark Payton, our Group Chief Operating Officer and CEO of Anasuria Operating Company Limited, will then provide an overview of the Marigold and Sunflower discovered oil fields, offshore in the UK continental shelf, in part 3. In part 4, Dr. Pascal Hoss, the CEO of Sea Hibiscus in Berhad, will provide an overview of our North Sabah Malaysian producing asset. In part 5, Yip Chee-yong, or CY, our Chief Financial Officer, will present the highlights of the group's 4th financial quarter results. Kevin Robinson, our Special Projects Advisor, will then conclude our presentation with some of our key messages for this quarter in part 6. Should you have any queries, you may contact our Investor Relations team via the email address provided at the end of this presentation. I shall now hand over to Uday.
Hello, this is Uday Jairam. I am Vice President Corporate Development at Hibiscus Petroleum Berhad. Let me commence this presentation by providing you with a brief introduction to our company. Hibiscus Petroleum was listed on the main market of Bursa, Malaysia in July 2011, with the vision to be a respected and valuable, pure-play, independent oil and gas exploration and production company. Our 2021 mission is to secure 100 million barrels of net proven and probable or 2P oil reserves and or entitlement, and achieve a net oil production of about 20,000 barrels of oil per day from currently held assets or potential new ventures located in areas of our geographic focus. We have approximately 1.6 billion shares in issue. These shares are held by more than 16,000 shareholders, with our core management team owning the single largest block of shares in the company with a 10.6% holding. Other corporate and institutional shareholders approximately hold a combined 56% interest in the company, while retail shareholders provide liquidity with circa 34% ownership. On the 8th of August 2019, our market capitalization stood at 1.6 billion ringgit. Hibiscus Petroleum is a component of the MSCI Global Small Cap Index, as well as the FTSE Bursa Malaysia Mid 70 Index. In addition, our listed securities are also Sharia compliant. Issued in March 2018 and set to expire in March 2021, we also have approximately 317 million warrants outstanding. The exercise price of these warrants is currently at 1 ringgit 6 sen. The exercise price will step up by 6 sen to 1 ringgit and 12 sen on the 20th of March 2020. Today, our key activities are focused on efficiently monetizing our producing oil fields and growing our portfolio of development and production assets in areas of our geographical focus. These are the United Kingdom, Malaysia, and Australia. The company currently has 2 producing assets, the first being the Anasuria cluster of oil and gas fields located in the UK North Sea, which we acquired about 3 years ago. Since our acquisition of this asset, the Anasuria cluster has contributed significant positive cash flow and profits to our company. Over the 4th quarter of financial year 2019, the Anasuria cluster delivered an average of approximately 3,000 barrels of oil equivalent per day net to our company. In addition to the Anasuria cluster, we became the operator of the 2011 North Sabah Enhanced Oil Recovery Production Sharing Contract, or PSC, on 31st March 2018. We have a 50% participating interest in this PSC, with the remaining 50% non-operated participating interest being held by Petronas Charigali, a wholly owned subsidiary of Petroleum Nasional Berhad, or Petronas, the national oil company of Malaysia. For our 50% participating interest in the North Sabah PSC, our estimated entitlement of daily oil production over the fourth financial quarter was approximately 5,000 barrels of oil per day. In summary, total oil and gas production rate across both assets averaged approximately 8,000 barrels of oil equivalent per day over the fourth financial quarter, of which oil production contributed 7,700 barrels per day. Within our current portfolio of assets, our total net proven and probable reserves as of 1st January 2019 stood at 50.7 million barrels of oil, while net contingent oil resources stood at 71 million barrels. Financially, our balance sheet is continuing to strengthen. As of 30th June 2019, our net assets stood at 1.2 billion ringgit, and our unrestricted cash balance stood at 207 million ringgit. We also continue to operate without debt. Our current portfolio, consisting of 1 exploration, 2 development, and 2 producing assets, is spread across 3 continents. In Asia, we operate a production sharing contract in Malaysia, while in Oceania, we operate in Australia. In Europe, we are present in the United Kingdom and have interests in several fields under concession agreement type arrangements. Firstly, we jointly operate several producing fields in the Anasuria cluster. Based on an independent assessment, the total net 2P oil reserves in the Anasuria cluster are 23.7 million barrels of oil as of 1st January 2019. Secondly, we're also the operator of Blocks 15/13A and 15/13B, a development asset. These blocks include the Marigold and Sunflower discovered oil fields. In Malaysia, we operate 4 producing fields under the North Sabah PSC, which together contain net 2P oil reserves of 20.5 million barrels of oil. In Australia, under a concession type agreement, we have approximately 6.5 million barrels of 2P oil reserves located in the Vic L31 West Seahorse development asset, which we operate. The future potential of each of our assets is further underpinned by volumes of oil which have been classified as contingent resources. In the United Kingdom, material contingent resources are located in the Marigold and Sunflower oil fields, in which we have a 50% interest. These 2 discovered oil fields contain approximately 30 million barrels of 2C oil resources net to the company. Another 7.8 million barrels of 2C oil resources net to the company are located within the fields of the Anasuria cluster. Additionally, the group announced on 17 July 2019 that we had signed a conditional non-binding term sheet to acquire the Crown discovered field, which contains approximately 8 million barrels of 2C oil resources. Technical due diligence on this transaction is currently ongoing, and we shall make the necessary disclosures on this transaction when more information is available. In Malaysia, our net 2C oil resources in the North Sabah fields amounts to circa 31.7 million barrels of oil. In the months and years going forward, we intend to gradually convert these contingent resources into proved and probable reserves or entitlement barrels, thereby further enhancing the value of our asset base. Finally, in terms of exploration assets, we also operate the Vic P57 license, which we believe contains exciting opportunities. In this license, 2 key prospects have been identified. The first is Felix, with best estimate prospective resources of gross 30 million barrels of oil, and the second being Pointer, with best estimate prospective resources of gross 170 billion cubic feet of gas. We currently have a 75.1% direct interest in Vic P57 and are now in the process of farming out the license for a carry-on well to be drilled in 2021 or 2022. A data room is in place with several companies currently assessing the opportunities that we have identified. The chart on your screen depicts the group's average daily oil production target over the next 5 years. Our target for the 2020 financial year is to deliver between 3.3 and 3.5 million barrels of oil across both the Anasuria and North Sabah assets. In order to achieve our 2021 mission of producing 20,000 barrels of oil per day, our main focus will entail enhancing production at Anasuria and North Sabah fields, converting our 2C resources, particularly in marigold and sunflower, into producing 2P reserves, high-grading exploration prospects and conducting further discussions on sharing nearby infrastructure to monetize the West Seahorse development asset, and continuing to look for opportunities to grow our asset base mainly in or around the areas of our geographic focus. Deepak will now take you through the details of our Anasuri asset in the United Kingdom in part 2 of this webcast.
Hello, I am Deepak Thakur. At Hibiscus Petroleum Berhad, I have two roles. I am the JV Asset Manager for the Anasuria cluster. In addition, I am also the Group Petroleum Economist. I will now take you through some information on our first producing asset, the Anasuria cluster, which is located offshore the United Kingdom. Our indirect wholly owned subsidiary, Anasuria Hibiscus UK Limited, or AHUK, has been involved in the joint operations of the Anasuria asset for over 3 years. This asset is located about 175 kilometers east of Aberdeen in 94 meters of water and has been in production since 1996. Based on an independent reserves assessment and the assumptions contained therein, effective 1st January 2019, the estimated remaining economic life of the asset is up to 2038. Our interest in the Anasuria cluster comprises a 50% direct interest in the Teal South, Gilmore A and Kite fields. We jointly operate these fields together with our partner Petroleum through a jointly owned legal entity incorporated in the United Kingdom called the Anasuria Operating Company Limited. We generally refer to Anasuria Operating Company Limited as AOC. The cluster also includes the Cook field, and in this field we have a non-operated 19.3% interest. We also own a 50% direct interest in the Anasuria FPSO. Included as part of Anasuria cluster are all components of the installed subsea production infrastructure and the Anasuria FPSO. Taking a closer look at the field layout, the subsea infrastructure underpinning the production of hydrocarbons is quite extensive and spans 25 kilometers from north to south. We utilize the services of Petrofac, a reputable international oil field service provider, in the role of duty holder for the offshore facilities, pipelines and wells. Our joint ownership of the Anasuria FPSO and the management of operating costs through a risk-reward type arrangement with Petrofac are key drivers in keeping our unit production cost at competitive levels for this type of facility. In Anasuria, the average uptime achieved for the current quarter of 87% is higher than that of the previous quarter. An improvement in operational performance is also seen in the average daily oil equivalent production rate of 3,053 barrels of oil equivalent per day in the current quarter. One crude oil offtake was conducted at Anasuria in May 2019, in which approximately 302,000 barrels of oil net to AHUK was sold at an average realized oil price of $66.84 per barrel. The average OPEX per barrel of oil equivalent in Anasuria for the current quarter was $20.93 per barrel of oil equivalent, an improvement to the $23.27 average OPEX per barrel of oil equivalent achieved in the previous quarter. The operational performance in the current quarter was primarily driven by two activities. The first was the scale squeeze operations conducted on the Gilmore P3 and Teal P2 wells, both in a single campaign. The second activity was the planned 2019 offshore turnaround, which commenced in late June 2019. To recap, an offshore turnaround in Anasuria is a periodic, planned activity when the Anasuria FPSO is completely shut down so that maintenance activities can be carried out to improve the overall performance of the production facilities. Offshore turnaround activities are also key to ensuring that we continue to provide a safe workplace environment for our offshore personnel. The last offshore turnaround was conducted in 2017 for a period of 1 month. Post the 2017 offshore turnaround, the average uptime improved to levels between 82 to 94%. It is hoped that subsequent to conduct of 2019 offshore turnaround, which completed in July 2019, average uptime levels will be maintained at current levels or further improved for the financial year ending 30th of June 2020. In summary, whilst planned maintenance activities affect operational performance, these are critical enablers of a safe working environment and overall can lead to an improved performance of the offshore facilities. Barring unforeseen circumstances, these measures, together with the production enhancement projects that are being executed this year, are expected to improve the operational performance of the Anasuria asset in the 2020 financial year. The projects identified on this slide have the common objective of taking us towards the target of delivering up to 5,000 barrels per day net to Hibiscus Petroleum by 2020. Referring to the projects itemized in the table on this slide, the Gilmore P2 sidetrack well, which was executed last year, has been contributing positively to the company since it commenced production in September 2018. The Cook Water Injector project, which was sanctioned in May 2018, consists of two phases. The first phase entails the drilling of a well through which water would be injected to repressurize the Cook field. The second phase is to install a pipeline connecting the new well to the water injection pumps located on the Anasuria FPSO. We expect the secondary recovery activity to arrest the natural declines of the production from the Cook well with the added benefit of delivering an improved recovery factor from the field. To recap, the Cook field is operated by Ithaca Energy, and this project was sanctioned by the joint venture partner in May 2018. Drilling operations on the water injection well commenced on 25th of March 2019, and on 2nd of May 2019, the well was drilled to a total measured depth of 13,045 feet, or at a true vertical depth subsea of minus 12,248 feet. Activities to drill and complete the water injection well were completed on 25th of May 2019 ahead of our base case plan. In drilling the water injection well, the reservoir pressure at the injection well location was found to be as predicted. Additionally, the oil-water contact is deeper than originally anticipated. The implication of a deeper oil-water contact is positive and is anticipated to increase our net 2P reserves in the Cook field. We will make a further disclosure when the detailed work to establish the latest reserves estimates has been completed. Work is also progressing to install a subsea pipeline to link the water injection well to the Anasuria FPSO. This is expected to complete by the end of September 2019, and the injection of water into the Cook field reservoir is expected to commence thereafter. Our total net capital expenditure for this project is estimated at 61 million ringgit. Of this amount, 38.9 million ringgit has been incurred in the period since the project was sanctioned and up to the end of the current quarter. The remaining 22.1 million ringgit will be incurred over the remaining months of the 2019 calendar year. Similar to the Gilmore P2 sidetrack conducted last year, the Gilmore P1 sidetrack project is an opportunity to drain additional volumes of oil by drilling a sidetrack well from the existing Gilmore P1 oil producing well. This project was sanctioned in the previous quarter, and the drilling operations commenced with the Stena Spey drilling rig mobilized to location and deployed anchors on 17th of May 2019. On 28th of July 2019, the well reached a total depth of 11,615 feet measured depth and encountered approximately 445 feet true vertical depth subsea of oil-bearing sands, with a net pay of 190 feet true vertical depth subsea in the targeted reservoirs of the Gilmore A field. The relevant hydrocarbon-bearing zones were perforated on the 16th of August. The well was then cleaned up and hydrocarbons were flowed to the surface. The well is currently being hooked up to the Anasuria FPSO. We will then flow the well through the production facilities of the FPSO, and once a stabilized flow rate has been established, the group will make the relevant disclosures. We expect that net capital expenditure for this project to be approximately 100 million ringgit, with an objective to unlock approximately 1.7 million barrel of oil from our current net 2P reserves. Barring unforeseen circumstances, these activities from the Gilmore P1 sidetrack well are expected to contribute to the delivery of production volumes in the financial quarter ending 30th of September 2019. I will now hand over to Mark, who will give you an overview of the Marigold and Sunflower assets.
Hello, I'm Mark Payton. I'm the Group Chief Operating Officer and the CEO of AOC. I will now briefly take you through the key points of our interests in blocks 1513A and 1513B. These are development assets also located in the United Kingdom. On the 17th of October 2018, we announced that our indirect, wholly owned subsidiary, Anasaria Hibiscus UK, had completed the transaction to acquire 50% interest in blocks 1513A and 1513B for a total purchase consideration of $37.5 million. The blocks are located offshore in the UK sector of the North Sea, approximately 250 kilometres northeast of Aberdeen, in water depths of 140 metres. Block 1513A consists of a significant oil-bearing discovered field called Marigold, whilst Block 1513B, which lies northeast of Block 1513A, consists of a smaller discovered field called Sunflower. Based on an independent report by AGR Tracks International Limited, the gross 2C contingent oil resources in the blocks are estimated to be 60 million barrels of oil. As we have 50% interest in the blocks, this translates to 30 million barrels of 2C contingent oil resources net to Hibiscus Petroleum. This acquisition presented an opportunity for us to expand our footprint in an area of our geographic interest and is consistent with our 2021 mission. In addition, given that production from the Anasaria cluster generates taxable profits, we believe that the development of these newly acquired fields may provide us with an opportunity to optimise our near-term tax position whilst accreting value to all our stakeholders through the addition of production. As the operator of these blocks, we have established a dedicated project team in Kuala Lumpur, coupled with a modest presence in Aberdeen, Scotland. The project team has been tasked with conducting the subsurface field development and engineering studies, and with the support of third-party contractors, execute the concept select phase as part of the effort to establish a field development plan for Marigold and Sunflower by the end of calendar year 2020. In terms of capital expenditure, approximately 1.2 million ringgit has been incurred in the current quarter for the pre-front-end engineering and design activities, which are targeted to be complete by the end of the next quarter. The development options being considered include the use of a fixed platform, floating solutions, as well as a tieback to existing nearby infrastructure. We have also identified several stranded discoveries around the Marigold and Sunflower fields. We believe that potential collaboration with concession owners of some of these stranded discoveries located around our blocks is feasible and will allow a reduction in overall unit development and production costs for all parties. This slide represents the potential value accretion of the Marigold and Sunflower fields as we achieve key milestones towards our first oil objective from these assets. We purchased interests in the blocks in which these fields are located, and based on reports from third-party competent experts, they contain approximately 30 million barrels of 2C contingent resources net to the group. We paid $37.5 million for these interests. This results in an acquisition cost of $1.25 per barrel. We are currently working on activities which will enable the selection of the appropriate development concept. Once the development concept has been finalised, our first key milestone will be the achievement of the final investment decision for this project to develop these fields. This will be followed by the securing of the approval of the Oil and Gas Authority for the Field Development Plan, or FDP. We target to achieve this milestone by the end of the 2020 calendar year. Based on benchmarking exercise of transactions of assets with a similar development cycle in the UK, the valuation metric for this asset is expected to increase to approximately $8 per barrel in the current oil price environment when the field development plan is approved. This results in an expected net valuation of approximately $240 million for this asset by December 2020. Furthermore, once the final investment decision has been made to develop these fields, we anticipate that we will farm out up to 15% of our interest in the Marigold and Sunflower assets. Our objective, of reducing our interests is to ensure that we are able to fund the development of these assets without overextending ourselves from a gearing perspective. The next key milestone would be to achieve first oil by the end of calendar year 2022. We anticipate that by first oil, the valuation metric could increase further to approximately $20 per barrel if current oil price levels are maintained and our current preferred development option is deployed. Assuming that we retain a 35% interest in these assets, this should result in an expected net valuation of approximately $420 million by December 2022. In summary, we are excited by the potential value to be derived from the Marigold and Sunflower fields. We see this asset as a game changer for the group, boosting our net oil production rate and establishing the group as a mid-size E&P player. On July the 17th, 2019, we announced that AHUK had signed a conditional non-binding term sheet to acquire 100% interest in licence P2366 from United Oil and Gas plc and Swift Exploration Limited for a total cash consideration of up to $5 million. Licence P2366 is located offshore in the UK sector of the North Sea, approximately 250 kilometres northeast of Aberdeen and 12 kilometres southeast of the Marigold field. It includes the Crown discovered field, which, based on information provided by United Oil and Gas, consists of 2C resources of 8 million barrels of oil and 6 billion cubic feet of associated gas. This transaction is an opportunity for us to aggregate 2C resources from the Crown discovery at a competitive unit cost per barrel and integrate these contingent resources as part of the Marigold area-wide development, with the objective of reducing the overall unit development and production costs. This proposed acquisition is subject to, amongst others, completion of satisfactory due diligence and receipt of OGA approval. Technical due diligence is currently ongoing and we shall provide an update on this status in due course. I shall now hand you over to Pascal to provide a business overview of our Malaysian North Sabah operations.
Hello, I am Pascal Hos. I'm the CEO of Sea Hibiscus Sendiri in Berhad. Sea Hibiscus is the holder of a 50% participating interest in the 2011 North Sabah Enhanced Oil Recovery Production Sharing Contract, or PSC. We are also operator of this PSC. The remaining 50% participating interest is held by Petronas Carigali Sendiri in Berhad. This is our first PSC in Malaysia, and our participating interest was acquired through a transaction with the Shell Group that was successfully completed on the 31st of March 2018. The North Sabah PSC has delivered production since 1979, and our production rights under the PSC continue until 2040. Through the PSC and the joint operating agreement signed with our partner, Petronas Carigali, we have a 50% participating interest and operatorship of 4 producing oil fields offshore Sabah, namely St. Joseph, South Furious, SF30, and Barton. We also have the operatorship of the Labuan Crude Oil Terminal and all other equipment and assets related to the PSC. As reported by our independent technical valuer, Risk Advisory, and based on our participating interest, the net 2P oil reserves of the fields under this PSC is 20.5 million barrels as of 1st January 2019 through to the end of the PSC life in 2040. Risk Advisory had also estimated that the 2C contingent oil resources in the fields covered by this PSC, based on our net entitlement, is 31.7 million barrels. Thus, we believe this asset holds a great deal of future potential. Subject to oil price and regulatory approvals, we hope to be able to allocate capital and our technical capabilities towards unlocking the available 2C contingent resources. The table on this slide shows the operational performance of the North Sabah asset over the past 4 quarters. That is, from the 1st of July 2018 until the 30th of June 2019, the first full year under our operatorship. During the current quarter, North Sabah production facilities recorded an average uptime of 94%, which is fairly consistent with the previous quarter. Average gross oil production increased by approximately 1%, due to better reservoir performance and production enhancement activities. Average OPEX per barrel for North Sabah for the current quarter marginally increased to $13.6 per barrel due to the commencement of plant maintenance activities. We expect OPEX per barrel to increase further in the next quarter as planned activities ramp up. During the current quarter, we conducted 2 crude oil offtakes. A total of approximately 491,000 barrels of oil were sold at an average realized price of $72.59 per barrel. Overall, we are pleased with our operating performance for this quarter. In April 2019, we were recognized by Petronas at the Reservoir Management and Surveillance Summit with the Production Delivery Award for our calendar year 2018 operations. We continue to work towards aggressive production targets and pursue cost reduction opportunities without compromising the high health and safety standards that are expected in our industry. Referring to the project shown on this slide, in August 2018, Petronas approved the St. Joseph infill drilling project through the Milestone Review 4 project maturation process. As part of the same process, Petronas subsequently approved the field development plan in December 2018. This project entailed the drilling of 3 infill producer wells utilizing a triple splitter wellhead from the St. Joseph Jacket A platform. There was also a requirement for minimal topside facilities modification. The total gross capital committed to this project is approximately 143 million ringgit. This is being shared equally with our joint venture partner, Petronas Carigali. A detailed project status update is discussed in the next slide. The jackup drilling rig utilized for the St. Joseph campaign is currently being mobilized from St. Joseph Jacket A to South Furious Jacket C to drill and complete 3 new oil production wells and 1 water injection well in the South Furious 30 or SF30 oil field. Like the St. Joseph infill drilling project, the SF30 infill drilling project entails the drilling of 3 infill producer wells at the South Furious Jacket C through the remaining conductor slot. We obtained Petronas approval in July 2019 for the SF30 infill drilling project development plan, which is intended to increase production and reserves of the South Furious 30 field. The total estimated capex is approximately 127 million ringgit, which will also be shared equally with Petronas Carigali. First oil production is targeted to flow in early November 2019. This project is expected to add around 4,000 barrels per day at its peak to our daily production volumes, with expected life of field reserves of 3.16 million stock tank barrels. The SF30 Waterflood Phase 1 project was endorsed by Petronas in July 2019 and is expected to commence following the completion of the SF30 infill drilling project. This project entails the drilling and completion of 1 infill water injection well through a new conductor, with the goal of scoping out the effectiveness of water injection as a means of repressurizing and providing long-term reservoir pressure support for the SF30 field. Phase 1 of this project is intended to assess the viability for a full field water injection project. The SF30 Waterflood Phase 1 development plan is expected to be approved in the next quarter with a total capital expenditure of approximately 51 million ringgit to be shared equally with our joint venture partner. Topside modifications will be required, which will entail deck strengthening and extension works. Upon completion of the drilling of the well, water will be injected through a small template portable water injection module, which will be housed at South Furious Jacket C. This 7-well drilling campaign is consistent with our objective to enhance production from the North Sabah asset and demonstrate that Malaysia is an integral part of our long-term business strategy. Drilling operations for the St. Joseph infill drilling project commenced on the 22nd of May 2019 when the PVD-1 drilling rig mobilized to the St. Joseph field location. The first wellbore, SJ105A, was drilled as a horizontal well and encountered approximately 1,000 feet of oil in the targeted reservoirs of the St. Joseph field. Subsequently, the project achieved first oil in July 2019. As disclosed on 24 July 2019, the SJ105A well was brought online and achieved a stabilized flow rate of above 1,000 barrels of oil per day. On 25 July 2019, the second well, SJ105C, was completed. This well was brought online and achieved a stabilized flow rate of over 1,300 barrels of oil per day. On 1 August 2019, the third and final well, SJ105B, was completed and achieved a flow rate of over 900 barrels of oil per day in its initial well test. The combined increase in production from the 3 infill wells of over 3,200 barrels of oil per day has exceeded the combined pre-drill expectations of approximately 2,600 barrels of oil per day, gross at peak production. This project is expected to add life-of-field gross reserves of 2.77 million stock tank barrels. Additional process debottlenecking activities are currently underway to reduce the back pressure on these new infill wells. This activity is expected to further improve the stabilized flow rates of the newly drilled wells. I will now pass you on to CY, who will take you through the financials of the group for the current quarter.
Hi, I'm CY, the group's Chief Financial Officer. I'll take you through the financial highlights for the current quarter. The current quarter represents the 5th quarter that actual North Sabah business performance data under the operatorship of Sea Hibiscus is being reported for detailed analysis. Earnings before interest, taxes, depreciation and amortization, or EBITDA, for the North Sabah asset is reported at approximately 77 million ringgit for the current quarter from the sale of 2 crude oil offtakes. The EBITDA margin for the current quarter increased to 52% from 50% in the previous quarter, mainly driven by the higher average realized oil price achieved in the current quarter. Net tax charge for the North Sabah segment in the current quarter amounted to approximately 29 million ringgit, resulting in a profit after tax of 32 million ringgit. Net tax expenses incurred in the current quarter were attributable to profits generated from the sale of crude oil. Tax accrued in the current quarter, when accumulated with similar accruals made in the financial quarters ended 31st March 2019, 31st December 2018, and 30th September 2018, represent the best estimate of total tax obligations for Sea Hibiscus as at 30th June 2019. Turning to the Anasuria segment, EBITDA for this asset was approximately 58 million ringgit, an increase of approximately 29% over the previous quarter. The EBITDA margin for the current quarter reduced marginally to 65% from 68% in the previous quarter. The weighted average cost allocated for the offtake in the current quarter covered a 3 to 4 months period as compared to approximately a 2 to 3 months period for the offtake in the previous quarter. Such a period represents the time taken to produce the crude oil for the respective offtakes. For the current quarter, profit after tax delivered by the Anasuria segment amounted to approximately 424,000 ringgit from the sale of 1 offtake. Net tax expense charged for the current quarter amounted to 39 million ringgit. Income tax expenses and net deferred tax liabilities recognized amounted to 26 million ringgit and 13 million ringgit respectively. The income tax expenses accrued in the current quarter, when accumulated with similar accruals made in the 3 previous financial quarters in the 2019 financial year, represent the best estimate of total income tax obligations for net income generated by AHUK via the sale of crude oil and gas. Net deferred tax liabilities recognized were driven by high investments in qualifying capital expenditure. A total of 49 million ringgit was incurred in the current quarter, mainly for the Guillemont P1 sidetrack project and the Coke Field water injection project, which resulted in approximately 90 million ringgit deferred tax expense being charged to the profit and loss account, an accounting transaction that is non-cash in nature. Whilst profits are extremely important, management's focus remains on delivering strong and sustainable EBITDA levels as long-term business continuity is of the highest priority. The group operates 2 producing assets in 2 countries. The tax regimes applicable in the oil and gas exploration and production sector for each of these countries differ. In Malaysia, the tax regime under which Malaysian oil and gas activities are governed is the Petroleum Income Tax Act 1967, also known as PITA. The provisions of PITA are applied to net taxable petroleum income at a rate of 38%. In the UK, the total tax rate for AHUK is 40%, which consists of a ring-fence corporation tax and a supplementary charge at 30% and 10% respectively. Any capital expenditure in the UK is fully deductible from the taxable income in the same financial year that it has been incurred, only after which both the above-mentioned taxes are applied, leading to a reduced amount of tax payable for that year. Simultaneously, deferred tax liabilities, which are treated as an expense to the profit and loss account, are recognized in the same financial year. Such deferred tax liabilities are non-cash in nature. In the UK, capital expenditure incurred in the financial year provides the benefit of immediately reducing tax payable within that same financial year. Apart from optimizing our tax position, capital expenditure also directly or indirectly leads to production enhancement, and thus we are always developing value-accreting projects for investment and implementation. Our business performance is underpinned by several factors, predominantly the price of the Brent crude oil benchmark at approximately the time of a scheduled offtake from our crude oil storage facilities. Given that oil price is affected by global macroeconomic factors, which are not within the control of the company, focus is placed on the operational performance of the assets, such as production rates and facilities availability, as well as the management of operational expenses. A key metric that we utilize to track our operational performance is average unit production cost. The average unit production costs for both the Anasura cluster and the North Sabah PSC are well below the average realized oil price achieved in respective quarters. As shown in slide 25, we have seen oil prices much lower and higher than current crude price levels, and we have managed on all occasions to remain profitable. The careful management of costs to maintain low operational expenditure and the delivery of production enhancement projects are key towards obtaining a low unit production cost structure. This is a significant contributor towards our profitability. We wish to reiterate that management's focus remains on delivering strong and sustainable EBITDA levels as long-term business continuity is of the highest priority. Over the past few quarters, our balance sheet has been gradually strengthening, more so with the introduction of the North Sabah asset as part of the group's overall business portfolio since 31st March 2018. We have built our total assets to approximately 2.4 billion ringgit, and shareholders' funds stand at about 1.2 billion ringgit. Year on year, total assets have increased by 21%, while shareholders' funds have risen by 24%. Net assets per share currently stands at 78 cents. In addition, as at 30th June 2019, the group's unrestricted cash balance stood at a healthy 207 million ringgit. The group paid the first tranche of deferred consideration relating to the acquisition of 50% participating interest in North Sabah, amounting to approximately 21 million ringgit or $5 million in March 2019, per the agreed schedule. Note that the second and final tranche, also amounting to $5 million, is payable in March 2020. The group had also paid the purchase consideration for the acquisition of the Marigold and Sunflower discovered oil fields, amounting to $37.5 million in cash, and fulfilled all of its periodic income tax obligations during financial year 2019, amounting to 97.5 million ringgit. The restricted cash recorded in our results relates to a security for our portion of the estimated cost of decommissioning the facilities of the Anasuria cluster. In this regard, we are required to periodically place monies into a trust, and this commenced 18 months after the completion date of the Anasuria cluster acquisition. This activity will continue until such time that the security has been fully provided. As of 30th June 2019, a sum equivalent to 66.8 million ringgit has been deposited with a UK trustee to support our ongoing obligations in this area. To note, the group remains debt-free, as all our activities and acquisitions to date have been funded with equity and internally generated funds. Over the course of the next 6 months, we anticipate that we shall undertake certain capital raising initiatives to ensure that the projects and opportunities we have in hand, which are expected to enhance production and create value, may be executed smoothly. We are evaluating our options bearing in mind factors such as long-term capital requirements, the overall weighted average cost of capital, as well as preference for the group to maintain a certain level of agility and financial flexibility amongst others. As our plans mature, we shall make the relevant disclosures. Before we wrap up, I would like to hand over to Kevin to highlight a few takeaway points.
Hello, I'm Kevin Robinson, Special Projects Advisor. I would like to close this presentation with some key messages. All metrics delivered for 2019 financial year originate from operational activities. Looking at our achievements during financial year 2019, the group's EBITDA and profit after tax increased by 63% and 13% year-on-year respectively. In total, we sold approximately 3.3 million barrels of crude oil across both assets in this financial year, exceeding our target to deliver 2.7 to 3 million barrels of oil from our two producing assets. There were 5 offtakes coming from Anasuria and a further 7 offtakes from North Sabah. In Malaysia, the St. Joseph infill drilling project has now been completed. 3 wells were drilled successfully with combined flow rates of 3,200 barrels a day, exceeding initial expectations of 2,600 barrels a day. In the UK, the drilling of the Cook water injection well and the Guillemot P1 sidetrack are completed. First water is expected to be injected into the Cook field in the 4th quarter of this calendar year, whilst production from the Guillemot P1 sidetrack is expected in late August 2019. Over the course of the financial year 2019, we received various production and safety awards. This includes recognition by Petronas for the production performance of North Sabah in 2018, as well as being awarded the Order of Distinction from the Royal Society for the Prevention of Accidents in the UK for 19 consecutive annual gold awards. In Australia, we were encouraged by the results of the subsurface evaluation work that has been completed approximately 2 years ahead of the minimum guaranteed work program schedule for the Vic P57 exploration licence. We currently have a 75.1% direct interest in Vic P57 and have commenced the process of farming out our interest in this licence for a carry on 1 well to be drilled in calendar year 2021 or 2022. The group's dividend policy has recently been established, through which the company may issue dividend payments to reward shareholders for their continuous support. Looking forward, we aim to deliver a total of 3.3 to 3.5 million barrels of oil across both producing assets in financial year 2020. Our focus will continue to be on maintaining low production unit costs and to generate strong EBITDA growth for the group. We hope to be completing the 4 remaining infill wells in North Sabah by the end of calendar year 2019. 3 oil production wells shall be drilled as part of the SF30 infill drilling project, and 1 water injection well under the SF30 water flood phase 1 project. As part of our objective to arrest natural decline and to enhance our combined net production to over 12,000 barrels of oil per day by 2021, we are planning an aggressive capital expenditure investment program for financial year 2020. Work on the Marigold field development is gaining momentum, and we plan to establish it by the end calendar year 2020. The potential addition of the Crown discovery will enable reductions in overall unit development and production costs for a Marigold area-wide development. We are continuously looking for opportunities in or around areas of our geographic focus to grow our asset base in order to achieve our 2021 mission. We are excited by the activities that lay ahead for Hibiscus Petroleum and hope all these developments will act as positive value-enhancing triggers for our shareholders.
And that's all we have for this quarterly earnings webcast. Thank you for tuning in.